Yo, 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 what's going on, family? How y'all doing? How y'all doing? Happy tax-free Tuesday. I hope y'all are excited to be here. I'm excited to be here. I'm welcoming all our current clients, welcoming all of our new clients. And anytime I get to tap in with you all and just give you all new strategies that I've learned and that I love teaching to help you all minimize your tax bill. That's why we are here, right? That's why we're here today, so we can learn how to save on taxes, keep the money in our pocket, and get it out the IRS. So while we wait for everybody else to get in the room, is there anybody that would like to come on and share a quick win? It could be personal, it can be business, but I love starting the class off with wins because I like y'all motivating me. Sometimes I need some motivation sometimes. So whoever wants to go first, let yourself off mute, come off and give a win.
Good evening, everybody. My name is Janine Holland. I am in Durham, North Carolina. And the win for me right now was just that I got into this mastermind family community. That was huge for me. And so I'm counting that as a win at the right time in the right season.
That is a win. That is a win. Because and I get it. I know Jenny taking that first step for a lot of people is nerve-wracking and scary. I was just telling my friend who was over last night, and he's making his first big investment in himself ever. And I told him like a part of like what a lot of people don't understand, part of the benefit of investing in yourself at an extremely high level is the person that you become because you made that investment. Like Jenny, I don't know about you, but so I'm from Chicago, South Side Chicago. And like when I was going to an investment, I'm getting my money back. Like, you know what I'm saying?
Yeah,
Like,
absolutely.
it's not an
Absolutely.
option. Like, I'm getting my money back.
I have to.
Yeah, I have.
I have to. My
It is.
daughter, our bank accounts are, she's an adult, but we still have bank accounts that are connected. And so when I made the wire transfer, she got a message and she called me. She was like, "Mom, what the hell?" I said, "Sid," and I used those exact words. I said, "Sid, mommy's making an investment in herself. It's not fraud. It's legit. I'm good. I promise." She was like, oh my God. Oh my God. I said, "You gonna learn something, sis. You hang with your mama. You gonna be all right."
I love it. I love it. Well, Janine, welcome in. We are happy to have you. Super excited.
Thank
So
you.
officially want to welcome you in. Anybody else want to go next? Going once?
I can tell you that we are so glad that we are a part of this. We wrote a huge check to the IRS, and then we just got a letter that we actually owe them $87 more.
They came back for the change?
Like 58,000 wasn't enough. We owe you another 87. Like
it costs more to ship the letter than it
He's like, you need to mail him a check because I think there's like a charge to pay it online. And it's like, oh, we paid enough. So we are excited to learn.
No, 1,000%. And Lindsay, one thing I can let you all know is that I think I mentioned on the challenge, we have about a 60% of our clients that come in when they do their prior year tax review. We're with our team, we're saving them north of $10,000. You know, not 65% of them, some 20, some 30, some 40. So I think one of your highest priorities is getting on that tax review call as soon as possible so we can see what mistakes your previous accountant made and we can fix them. And then you're going to be sending the IRS a letter saying, hey, you owe us some money, okay?
Yeah. So question, where do I find that tax review call? How do I sign up for that? Because we signed up for a one-on-one, but I looked around the website.
Once you go to your one-on-one, they'll give you all the links for the rest of the call. But we really want to start off with that one-on-one, that review, because we want to review everything and we'll help you strategize what we think your like next step should be.
Cool.
We
are excited.
And what's your husband's name?
Dave.
Dave, how you doing, brother?
Good, buddy. Thank yourself.
I'm amazing. Even better now I'm talking to you, you know?
Nice.
Yeah.
We're stoked.
I found you on the Instagram live while he was on a trip in Las Vegas. And I was screen recording and I'm sending him clips and he sat down on Monday like not really knowing what he was getting into, and here we are.
Did,
So.
did I hook you after Monday?
You did. You did. You did. I was pretty stoked. Let's just say that.
I love it. I love it. And where you all based out of, if you don't mind me asking?
East coast of Florida, Central Florida.
Okay, nice,
Yeah.
nice.
Space Coast.
Gotcha, gotcha. Well, welcome into the family. Welcome into the tax savings. Welcome into the investment earnings. Welcome into all that amazing stuff that we're going to be able to help you all with. So let's do one or two more, and then we'll get class started. You can just come off mute if you would like. And if that's nobody, I'm probably gonna call on somebody.
What are we doing?
Sharing a win. My bad for the new people. Just sharing a win if you got a win.
Okay, I just started my Honeybee Sweet LLC. I'm a beekeeper and we'll be selling honey.
Nice. When did you started this year?
I just started yesterday. Well, I've been a beekeeper, but I just started the LLC. I'm getting ready to do beekeeping classes and bee inspection classes.
I love it. Well, congratulations on your new business. We are excited for you. And if you haven't seen the movie Beekeeper, it's a really, really good movie that just came out. One of my favorite movies of 2024. And I know, so I think, I think you owe it to yourself. I think you owe it to yourself to watch that movie.
I will go see it. Thank you. I appreciate it.
Okay, cool. Well, we can go ahead and get class started. Let me just send this link out.
One more thing, I'll send the link in the thread so you all can sign up for when the honey's ready. If you would like some organic sweet honey, it's so sweet, it tastes like butter, sweet butter.
Okay, okay. Please drop that in the link so that we can check it out. We got you. Okay, cool. Well, welcome into Tax-Free Tuesdays, guys. And again, these classes are to keep more money in your pocket and out of the IRS. So when I teach these classes, we go over a different strategy every time. And the goal of that is to, again, every strategy won't be for you, but when you find the strategy that is for you, you make sure you execute it. And any strategy that you hear that you want us to help implement, you can always reach out to our tax team and say, hey, do I qualify based on my situation? Do I qualify to take advantage of this tax saving strategy that Carter discussed in the last call? And our team will help you with that. But I just believe that education is so important. And like I mentioned it in a challenge, I'll mention it again today. Taxes is everybody's number one expense, and I am devoted to helping you all minimize it as much as possible. Now, today's topic is probably one of the few strategies that can eliminate all of your income. And I mean like all of it, to where you can pay $0 in taxes. And there aren't a lot of tax strategies that W-2 employees can take advantage of. But this is one of the strategies that both W-2 earners and business owners can take advantage of. And I learned this strategy about 2 years ago from a dear friend of mine. And when he told me, y'all, when I say for the next 30 minutes, I was scooping my head off the floor because I couldn't believe that this was possible. This is probably one of the biggest strategies I've learned in the last 2 years. And I was going to teach it to you all today. But then I was like, why don't I just bring in the same person who taught it to me to teach it to you all? Because I want you all to have the same reaction that I had when he taught it to me. So I'm gonna bring this gentleman up to the stage. And I'm gonna let him teach the class, and then I'll be here for Q&A and everything. But I was like, why would I teach it? Maybe I'll do it the best justice, but I'm gonna go ahead and let him teach it so that he can give y'all the same game that he gave me. So this is my amazing friend, colleague, friend-tour, Mr. Carlton Dennis, who is just a phenomenal tax strategist in the space. Me and him connected about 3 years ago in LA. And the crazy thing about it, most people would think that if it's two handsome, young African-American men teaching this exact same topic that we would like look at each other as competition, but we are collaborators more than anything. He teaches me a lot and I teach him a lot, and we speak in each other's programs because we understand the power of collaboration. So without further ado, Mr. Carlton Dennis.
Woo! Welcome me onto the stage. I appreciate it, Carter. First off, I got to give a huge round of applause for one of the best tax professionals in the entire game. You guys have no idea how many times me and this person have called each other to sit and just talk tax jargon and nonsense over the weekends. Monday through Friday, we were sitting talking tax strategy 24/7, and we get to bounce ideas off of each other. It's funny how me and Carter met, because he's right. We did get a chance to meet in Los Angeles, and he invited me to this place called, I believe it's called the Center Club.
Soho House.
Yeah, Soho House.
Yeah.
And we got to connect at Soho House. It was a good time. But before we connected, I was on IG, posting my stuff on IG, sharing tax knowledge. And I was talking about vehicles that weighed over 6,000 pounds and setting up LLCs. And I saw this other chocolate guy on the internet talking about vehicles that weigh over 6,000 pounds and LLCs as well. And every time that I was posting about placing children on payroll, he was posting about placing children on payroll. Every time I was talking about real estate, he was talking about real estate. Every time I'm in the kitchen, he's in the kitchen. So I had to figure out, who is this other person? And sure enough, I look in my DMs and he had already sent me a message. Brother, I love what you're doing. You are killing it in the tax game. When can we link up? 48 hours later, we were sitting down in LA for 3.5 hours talking tax strategies and sharing our secrets with each other. Fast forward 2.5 years later, we're close friends, hopping on each other's masterminds. He got me to fly out to Jamaica. I get him to fly out to California, and we are changing the entire tax industry. Now, that being said, Carter did bring me on to this training to teach a very important tax code, one that I've spent probably the last 3-4 years of my life exploiting. And those tax codes are around real estate investing and, more importantly, the passive activity loss rules. I pride myself on being able to show other people how to legally pay 0% in income taxes every single year with real estate. And if you will allow me, as a matter of fact, because I don't have to teach on this, I want to get 30 yeses. If you guys will allow me, I'm going to go into the exact same strategies that I utilized for me and my wife that were able to wipe our tax bill down to $3 last year in 2023, and how my clients were able to offset their income taxes by investing in real estate. Would you guys be okay with me sharing the exact same strategies that I teach my mastermind members that I'm working on with my clients? Can I deliver that to you here today?
Not only that looks like more than 30. And not only can you deliver it, I'm gonna get out your way and give you full screen so they can see you. They don't need to see me for this. They can see you, but $3 is crazy.
I appreciate that. And yes, that is $3 on the federal side, guys. And I'm not afraid to show my tax returns and to show what I did. As a matter of fact, you guys will see into a lot of the strategies that I cover in today's presentation. So without further ado, we're going to jump directly into this. I'm not going to bore you with a whole lot of information that doesn't make sense. I'm going to go directly to the heart of the stuff that's actually going to be impactful for you guys. So I would encourage you to buckle up, grab your financial literacy journals, some type of journal that you can write in, because there's going to be a lot of information that's covered in this training. Before I jump into some of the things that I'm going to teach you, just keep in mind that you control what you pay in taxes. I don't, Carter doesn't, Biden doesn't, Trump doesn't. You control what you pay in taxes, and your ability to have the right tools and information will dictate whether or not you'll be owing more than you should. Agreed? Now, let's dive into this. Before I jump into all the tax strategies, I kind of have to tell you a little bit about my background. Me and Carter have different backgrounds. Carter went to school for accounting as a CPA. I did not go to school for accounting, okay? I had no intentions of wanting to become a CPA or a tax professional. As a matter of fact, my journey began off in football. So I was a full ride scholarship athlete to Cal Poly San Luis Obispo. I played the cornerback position. I thought I was going to go to the NFL. You guys have heard this story before. I looked at myself multiple times in the mirror. I was 5'9". There was nothing I can do about it. They didn't have those knee surgeries yet where you can give yourself an additional 3 inches in your knees. So I knew I was not going to be able to make it to the NFL unless there was a miracle that was happening. So that being said, right towards the end of college, I picked up modeling. And if you guys know how football athletes work, we latch on to whatever is nearest to us. Okay. What was nearest to me was the weight room. So I was going into the weight room, killing it every single day. And I had a body to show for it. So I picked up modeling as a career heading towards the later months of my last year of being in college. That being said, my scholarship checks started to run out. If you talk to any scholarship athlete, they'll tell you it was a very big wake-up call when you stopped receiving those scholarship checks. It's like being on unemployment and stop receiving unemployment checks. You're like, what's going on? I got to work now, right? That's literally how I felt. So I got a job working for Gallo Wine Company. How many of you guys have heard of Gallo Wine Company? They sell Barefoot Bubbly, Andre Champagne, those big jugs of Carlo Rossi. Do not buy those. You know what happens when you try to drink one of those, guys. Don't do it, right? So that was my job. I was working in downtown LA, and I would go into grocery stores in the middle of the night. It felt like it was like 3, 4 o'clock in the morning, right when the pallets of liquor were being dropped off at the grocery store. And if you were really good at helping the grocery manager stock the liquor onto the shelves and helping with some of the displays that were on the floor in the wine and cheese section, in the beer section, whatever it might be, they would let you buy alcohol in excess of what fit on the shelf. So I got really good at sales, guys. When I say I got really good at sales, like I got really good at sales to the point where I sold myself on the fact that I was a celebrity fitness trainer. I went and changed my Instagram bio from Carlton Dennis fitness trainer sales rep to Carlton Dennis celebrity fitness trainer sales rep. So I was now a celebrity fitness trainer, had no celebrities, by the way. I'm just painting my story here, guys. All right. I didn't get to graduate with the accounting degree like Carter. So this was what was going on for me. I was 21, 22 years old in downtown LA, working for Gallo Wine Company, posing as a celebrity fitness trainer. And guys, I was pretty buff at the time too. So I looked like I could fit the description. I at least looked like I could fit the description. Here's what I want you to know. Uncle Sam, who, by the way, I still to this day have never met him in person. He's never showed up to Christmas, Thanksgiving. I love food. I never see him at Thanksgiving. I got a letter in the mail from this guy, and he said that I owed on my 1099 income that I made that year as a personal trainer. Here's the issue. When I got the bill from Uncle Sam, again, the person I don't know, the bill was more than what Carlton Dennis had in his checking account with US Bank. I could not understand how someone told me I owed them more than what I actually had. And this was my first wake-up call to what owning a business was like, having to budget my money for taxes, and actually even knowing that there's somebody that collects taxes. So, like many of you guys who have probably been in this situation before, all of my hard-earned money that I was saving went in a check that year to the government, and I took a step back from my business. I was like, hold on a second. Clearly, I don't know what I'm doing, and this sucks. How do people actually build wealth like this? Well, I called my mom, who's America's tax lady. She had been speaking on the news channel, KTLA, CNBC. Oprah Winfrey had my mother on her website as the top 50 biggest women entrepreneur of 2020. Like, my mom has been doing killer stuff. She's a badass. She's just been in the space for 30 freaking years, guys. Okay. So she's what I would consider one of the GOATs of the tax game, one of the greatest of all time in the tax and accounting space. And if you don't know who Carla Dennis is, go look her up. You'll find out very quickly. She's all over the internet, right? That being said, guys, my mom was a little bit embarrassed when I called her. She was like, what the hell were you doing? Why did you just call me that you started this personal training business? You know, I would have helped you set up an LLC. You know what? I would have helped you figure this out. Well, believe it or not, guys, I was that personality where I was trying to prove something. I didn't go to the NFL. So I wanted to prove to my parents that I can get a successful career. I didn't really kill it at my first job. So I wanted to prove that I can start the side hustle business. Well, while I was trying to prove all these things, guess what happened? I got burned by Uncle Sam. And luckily, I had a mother who knew enough information around the tax game to be able to help me get out of it. But here's what I did, guys. Because I'm smart and I was good at sales, I sold my mother on allowing me to start a sales division inside of her company. Now, hear me out, guys. Hear me out. My mother at the time, she was all radio, all TV, television, newsletters, in-person events. This was way before COVID. People would actually look at their emails. Like, this was how people actually did business. You look in your mail and there's a local tax person that's sending you a card, right? My mom gained lots of business like that, but she had no sales team. And most traditional accounting firms never had sales divisions, did they? And many of you guys can contest, they don't. So this was an opportunity. I didn't have my tax license yet. I knew nothing about taxes, but what I did know, I'm pretty good at sales. Put me in front of somebody, I can get a deal done. I don't know anything about taxes yet, but give me an opportunity. So I sold my mom on letting me work for her, and I went to work. This is what I was working on in my first couple of months being in my mom's office. As you guys can see, I went from 200 pounds to 240 pounds. I thought I was going to become some physique trainer and compete for Mr. Olympia. I actually didn't take taxes in my mother's office seriously at all. As you can see in that left image, I am eating a bowl full of rice and tilapia because that is the lowest carb fish allowed. And I'm just getting my carbs in with some rice. In the middle there, you'll see that I have 2 battle ropes on the beach, not solving any tax problems, but Lord knows that I was pounding them battle ropes into the ground. And then on the right side of the table, I'm pretty sure I broke those exercise bands right after this photo was taken. Guys, I was not focused on trying to grow my wealth in tax strategy or accounting. I was more focused on trying to become a fitness guy. Can you see that now? That being said, I have a Black mother and she does not deal with it. So after 6 weeks of working for my mother's company, she invited me into her office and she said, "Hey, Carlton, listen, I know you haven't sold anything." And I was like, "That's weird. How do you know I didn't sell anything today?" She's like, "You made yourself a commission structure, not a salary structure. You only make money when you sell things. You haven't sold anything, and you sold me on the fact that you wanted a commission structure." And I was like, damn, she's right. I hadn't made any money working in my mother's office. I was literally just taking up space. So what she asked me to do was she said, "Carlton, I want you to shadow me for the day. Sit in my office, listen to me for the day. I have a few consultations. I'm going to sell these people into our company. Maybe you can turn around and just listen and learn how to do it too." I said, fair enough. At the end of the day, it gives me the opportunity to not have to sell and I can sit there and learn. So I sat there and learned from my mom. Now, the first couple that came into the office that day were a husband and wife. They were just looking to file their returns. Many of you guys are probably aware after being in this mastermind with Carter, understanding the difference between filing a tax return and doing tax strategy and planning. So they came in and it was just a routine appointment. They got in and they got out. That being said, the very next couple that came in, they showed up, husband and wife. They had a daughter with them. They had a different energy. Their energy wasn't around, let's get these tax returns filed. Their energy was around, hey, Carla, you know that our business has grown. We've known you for the last 2 years. This year, we're coming into some more money. What do you recommend we do to reduce our liability? Then my mom, and guys, I'm sitting here in the corner watching this conversation happen. So I just want to make sure I preface this. I watched my mom elaborately go through this pitch. It was like the first time opening the gates to Willy Wonka factory. You just see nothing but candy everywhere. She was just elaborately explaining what tax planning was, how you're going to leverage the tax code to the fullest extent. We're going to have all of these business deductions ahead of time. I just watched it just flow out of her mouth like the chocolate coming out of the chocolate fountain in that movie. That being said, I know you guys are listening to me. She slid them an engagement agreement. I had not known what engagement agreements were because I never closed the deal yet. Okay, making sure you guys are understanding where I'm at here. She slid them an engagement agreement, and on the engagement agreement, it wrote $25,000 tax planning service. Now, at the time, I was in my office, the office where I was working on my fitness training business, writing workout programs, and I was pretty aggressive in my prices. I was charging $200 for a 30-day workout program. $200 for a 30-day workout program, $25,000 in a 30-minute consultation. I did not have to major in accounting to understand the math in this one, guys, okay? The math wasn't mathing with the personal training. And so I wanted to come do the math with the tax strategy. Please let me know if you guys are understanding this situation that happened in my life here, okay? I got pummeled by this tsunami of money that just came in, and I had never seen money like this before in my life. How do you make $25,000 in 30 minutes? Carlton, you do it with your information because people will always pay you more for this. Done. All right, I'm going to Target. Carlton, why are you going to Target? Because I'm buying a voice recorder. And yes, I did, guys. That night, I went to Target and I spent $18.97 and I checked out a Target and I had a black voice recorder. I went into my mother's office that very next day and slid it under her desk and hit play. From 8 o'clock until 5 o'clock, I had my mother's voice written down now. I sent it over to rev.com and they transcribed it into a script. Now I had her whole day transcribed into a script, everything she said. I got a nice little yellow highlighter and I highlighted everything that I heard that made sense right before the deal got done. And then guess what happened? Oh boy, I got lethal. I got rid of that Kia Spectra I had and I upgraded to an Audi A4. Now I'm the sales genius here. So I downloaded Grant Cardone's sales training program and spent $10,000 on that. I bought every sales book that I could find because what did I want to get better at? Sales. Keep in mind, what have I not picked up yet, guys? What have I not picked up yet? Okay, thank you, Mika. I didn't have the information and tax strategy yet. I'm over here developing the sales skill. Do you see what I'm getting at here? Now, something happens, and I know you guys are probably waiting for this. I got humbled here. Something happened to me. I normally like to take my consultations when I was 22, 23 years old at my mom's office. I used to like to take them over the phone because traditional salespeople, you get on the phones, you get the deal done. This person that came into the office this day, his name was Carl. I'll never forget this name because my name is Carlton. You don't forget Carl's. That being said, he was married. Him and his wife are older, 70s, 80s, I would say. They were beautiful, by the way, guys. An older couple. You could tell they had a lot of money by the way they dressed, but they were modest. That being said, when they sat down with me, they were a little reluctant to sit down. They're like, okay, where's your mother at? Like normally we deal with Carla. And I immediately went into my normal pitch that I had trained 1,000 times. The difference, though, between this pitch and the thousands of other pitches that I did was this guy had brought his tax returns into the appointment. And while I went through my pitch, he stopped me and said, your name is, and I said, Carlton. He's like, it's a pleasure to meet you, young man. Here are my returns. Let me know what you can do for me. And I sat there. I looked down at his returns and I opened the first page and believe it or not, and it's up to you whether or not you want to believe this. I read on line number 1, $90 million revenue. Now I get, well, this guy's a little bit different here. Okay. I had never seen $90 million ever, nor on a tax return, nor all in the same tax return, nor all in the same year on a tax return. Then I kept flipping and I see oil and gas. This guy owns oil and gas companies. Then I flip. He's a co-owner of Tyson Meat Company. Then I keep flipping. And then just pages and pages and pages of assets drop out of the tax return. I didn't know how to read this yet. What do you think I did, guys? What do you think I did knowing what you know about me? I went back into the same pitch, didn't I? Oh, this is what we do with tax planning and da 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 da. He stopped me again. He's like, I can tell that you aren't reading my returns. How about we do this? Let your mother, Carla, know that I will be back next week. It's been a pleasure to meet you, Carlton. Him and his wife got up, shook my hand, and walked out. Now, my bench press at that time was about 450. My squats, 500 plus. Power clean, 300 max. Every ounce of testosterone Carlton had left in his body evaporated like a little balloon fuzzling away. That's what happened. I had never felt more soft, more like a dog with a tail tucked between his legs than this moment in my life. Never again am I going to show up like that. So what did I do? I looked up online, what is the highest designation the IRS gives to tax professionals without you having to go back to school to go get an accounting degree? And guess what it was? It was the enrolled agent's license. So I went and got my enrolled agent's license, which is the highest designation the IRS gave. And it took me 6 months. And now we are here today. Fast forward, I'm speaking with realtors, around United States, business owners. I started a YouTube channel that has over 700,000 subscribers. I think we're the largest tax strategy YouTube channel. And I get to work with athletes, entertainers, musicians. Guys, some of my favorite, the music I like, I get to work with those musicians. Like, that is so cool to me. People who you see on Netflix are probably my clients. That is so cool to me. But I didn't get all the way to this place without having to humble myself. And one of the things that I learned in the tax code that separated me from other tax professionals was my proficiency around tax strategy and being able to teach people how to use real estate to offset your tax. As a matter of fact, I felt like I had gotten hit by a bus and woke up with superpowers. Now I just wanted to teach other people how to unlock the superpowers inside of themselves. How do I get you to understand how important the tax code is so you can pay 0% too? Because now that I have this tax information coupled with all that sales information, I felt lethal, right? So here's what I want to go over with you guys today. And now I'm taking off my jacket. I'm already warmed up. Now I'm warmed up. Jacket's coming off. I want to teach you how to leverage the tax code to the fullest extent. And by the end of this training, I'm confident that all of you guys will feel like you know. I'm going to teach you why the wealthy pay 0% in income taxes every single year and how it's a process that they're repeating, because I know we all love processes. And then I'm going to teach you how to not fear the IRS, because Uncle Sam is a real person. However, he's not a real person you should be fearing. So let's talk. First thing I want you to understand is I became curious, like many of you guys did. You probably became curious, which is part of the reason why you are in the tax-free living mastermind. If you aren't curious to figure out why other wealthy people were paying 0%, you probably wouldn't even be here. I became curious around Robert Kiyosaki. I became curious around Grant Cardone. Why? Because Grant Cardone and Robert Kiyosaki were two of the only entrepreneurs at the time when I was young who were bold enough to brag about not paying taxes on the internet. They were bold and bragging about it. You know who else brags about it? Whether you side with him or not, Donald Trump brags about it. Mitt Romney bragged about it, right? These taxpayers were bragging about not paying taxes, and I didn't know why. I became obsessed with it, okay? So I wanted to know why Tom Wheelwright was Robert Kiyosaki's best friend. Tom Wheelwright is Robert Kiyosaki's CPA. I started realizing that Robert created this framework. How many of you guys have seen this framework? Let me know in the comments what this framework is, in case you don't know. What is this framework, guys? I'm waiting for the answer. Come on. Come on. What's this framework? Thank you. The cash flow quadrant. Thank you. Okay. So this is the cash flow quadrant. What was the purpose of Robert leaning on the I quadrant? Why was he so focused on trying to get taxpayers over into the I quadrant, the investor quadrant? For those of you guys that have read the book, Rich Dad, Poor Dad, why was Robert infatuated on the I quadrant? What was he trying to do? What was he trying to tell us? You might know. Okay, I like that answer. No taxes, focus on what you need to do. What he was trying to tell us, guys, for many of you guys that are aware, is how we can go from being in the employee quadrant where we're trading our time for money to investing our money where our assets are working for us and we don't pay any taxes. It's that simple. He's like, if you literally do what the government wants you to do, you can legally pay 0% in income taxes, which means you need to become a professional investor. Here's the thing, though. Robert created these other two categories, S and B. And he said you can go from the employer quadrant to the S quadrant, from the S quadrant to the B quadrant, from the B quadrant to the I quadrant. When I talk to a lot of taxpayers, I don't really see a lot of these taxpayers really going from being an employee to starting their own chiropractic practice to then all of a sudden having a large corporation like Amazon to then becoming a professional investor. I didn't see that for many of my taxpayers. But what I did see was a bridge to where we can go directly from employee to I, or directly from the S quadrant of self-employed to investor quadrant. That's what I became obsessed with. How do I get you to the I quadrant as fast as humanly possible? Because in the I quadrant, you have the ability to pay 0% in income taxes. I want you to become a professional investor. I want to make sure you guys are all writing that down, okay? So the reason why Robert was so obsessed with this is because Robert knows that there are far more opportunities for real estate investors to reduce their taxes within the tax law. And yes, these opportunities within the law can help you offset your W-2 income as well as your 1099 income. Now, Carter and I, we talk all the time about buying vehicles that weigh over 6,000 pounds because of a very important tax code called IRC 179. How many of you guys are aware of IRC 179, the ability to write off a vehicle that weighs over 6,000 pounds in 1 year at 60% bonus depreciation for 2024? Put a yes in the chat box if you got that strategy locked in. If you got that play locked in, I want to know. Yeah, I probably bought a little too many cars. I'm kicking myself in the butt right now. I bought a few vehicles over 6,000 pounds. My wife has a Mercedes G-Wagon. I have a Lamborghini Urus. We have, those are actually our two 6,000 pound cars, actually. We only have two. I bought the Ferrari, though. That was a little bit of a splurge. I don't second guess that one. We're not even going to talk about that one. The Ferrari's staying, guys. But yeah, we have a Tesla as well. So we bought a couple of vehicles that we've written off on our tax returns. The IRC 179 allows for this. But what about in real estate? How do you get write-offs for real estate? Everybody knows that you can write off the interest on a loan and property taxes, but what about the investment property? How do I write off the whole enchilada? Well, just like you can write off a vehicle all in 1 year at 60% bonus depreciation, you can write off an investment property. And guess which one costs more money? Which one costs more money, guys? Does a car or an investment property cost more money? Put car in the chat box, put RE in the chat box if you think real estate, or property in the chat box if you think property costs more. Okay, so obviously real estate costs more. Question I have for you guys, which one is actually a real asset? Which one's a real asset? Okay, real estate, thank you very much. And real estate, when I ask many of my clients, you know, how do they wish to retire? They always tell me, I believe I'm going to retire off of having a good amount of money saved up in retirement and owning real estate. So real estate is that sexy strategy I like to leverage, because guess what, guys? You can only buy so many cars that weigh over 6,000 pounds, can you? Okay, so let's talk about the strategy in real estate, and it revolves around the cost segregation study. I want you to write that down. Now, what the cost segregation study means, it's a tax strategy. Instead of being able to write off your property, which, by the way, when you buy residential real estate, you're able to recoup your investment over 27 and a half years, which is a long time. Rather than waiting 27 and a half years to recoup your investment in your property, why not accelerate the depreciation? Just like you accelerate depreciation with your vehicle. The IRS allows for you to get the cost associated with all of the components that make up your house, and you can segregate them and perform a study and write them off. That is the word: cost segregation study. I'm going to get the cost of all of the components inside of my property. I'm going to have a tax professional segregate all of the components in my property, and I'm going to write them off in a quicker amount of time. Now, the beautiful part about owning real estate, just like with owning a car, is we're going to take out leverage. I'm going to go to the lenders and get a loan in order to buy that Ford F-150. Just like with an investment property, I'm going to go to the same bank and get a loan to go buy that investment property. One asset just costs a lot more than the other, which means one asset should give me a bigger tax write-off than the other. This is the game that wealthy people play. How do I stack up my deductions with real estate? I'm going to share with you how. Now, in simple terms, a cost segregation study is a tax strategy used by savvy real estate investors to accelerate depreciation on residential or commercial business property to provide the investor with additional upfront cash flow for additional investing. You just went to the bank and you got a $400,000 loan. You're going to put $100,000 down on a $500,000 investment property, 20%. You leverage the banks for the other $400,000. However, when you close on the property, you're going to get a closing statement that's going to tell you two things. Here you go, Mr. Johnson. Here is your building that you bought. And here's your land that you bought. Anytime you buy real estate, you're buying both. You're buying the property and the land that the property sits on. Agreed? Now, the IRS only allows for us to write off one of these components. Does anyone know which component we're able to write off? Which one? Is it the building or is it the land? Which one are we able to write off? Awesome. I love this. I love that you guys know the answer to this question. The building. The reason why we are not able to get a deduction for land is because land was already here before we as humans decided to occupy this earth and build on top of it. The building amount is the true value that can be associated with something for tax purposes. Land does not wear and tear. The land is going to always be here. It's going to sit outside, the rain, the sleet, the snow. That is land. But your building that's sitting outside in the rain, the sleet, the snow, the hurricanes, the tornadoes, that's going to wear and tear down. And the government's going to allow for you to recoup the cost of the wear and tear, AKA depreciation. That's depreciation. I am recouping the cost of the wear and tear. Here's what I want you to know. You get to claim 30% of your building's value as a year one tax deduction. So let's just say on that $500,000 property that you and I purchased, $400,000 is the building and $100,000 is the land. 30% of $400,000, guys. I'm claiming $120,000 deduction. Let's talk about how this actually works out with some bigger numbers. So let's just say, jumping back into our example here, let's just say that I owned an investment property that kicks off $500,000 in passive income. So I'm collecting $500,000 every single year, and I'm using bigger numbers to make this simple. And after I perform that cost segregation study, that strategy that allows for me to accelerate depreciation, I'm looking at a $1.5 million real estate expense. Because I have this $1.5 million expense with only $500,000 in income, I got $1 million loss. Because I have $1 million loss, I'm going to go use that $1 million in real estate losses against other forms of income, like W-2 income or even 1099 income. If I'm offsetting $1 million of W-2 income or $1 million of 1099 income with rental losses, how much taxes am I paying? How much taxes am I paying? Thank you very much, Karen, Lorenzo, Natalie, Debbie, Kenyon, Lolita, Trevor. I'm paying 0% in income taxes. I cannot even begin to stress this enough because some of you guys, this is just going to be information and it's going to go right over your head. But for some of you guys, this will be the true difference in how you don't pay taxes this year. My wife and I literally do this every single year. We have enough depreciation on our tax returns because we're active enough in acquiring enough real estate to where we can offset the money that comes over from my S corporation, Tax Alchemy. And it's in the 7 figures. I don't play around with this strategy. This is the strategy I use. This is the one that I'm going to take with me to the grave. I want you to understand that this is one of the most powerful strategies in the entire tax code. Now, that being said, everything changed in 1986. If you didn't know, Ronald Reagan was around in 1986 and he implemented the Tax Reform Act. And when he implemented the Tax Reform Act, he closed up our ability as real estate investors to just buy real estate and offset our W-2 and 1099 income. And the way he did this was he separated income into 2 buckets. He said there's not just going to be income, there's going to be passive income, and then there's going to be non-passive income. And if you're working a W-2 job or you're self-employed, I'm going to label this moving forward forever as non-passive income. And if you own investments, we're going to label this as passive income. Ronald Reagan implemented non-passive and passive income in 1986. Can you believe that? That being said, that reduced our ability as taxpayers from being able to buy real estate to offset our W-2 and 1099 income unless we materially participated. Now we actually have to manage our own investment properties in order to make it an active business. So here's the bottom line. Ronald Reagan said, if you are not materially participating in your real estate business, you should not be able to benefit from the losses from your real estate business. Okay, I can understand where he's coming from. If I'm a W-2 taxpayer working as a physician, doctor, or attorney, working 40, sometimes 50 hours a week, I'm making a lot of money. So I might take that extra money after I paid my bills and park it into real estate. And simply parking that money into real estate, whether I manage it or not, allow for me to avoid all of my taxes on the W-2 side. I could see how this can kind of bother presidents like Ronald Reagan when they can see this being a shelter to avoid taxes simply just by owning investment properties. So Ronald Reagan implemented what's called the passive activity loss rules. And because he implemented the passive activity loss rules, we no longer can use real estate losses to offset our W-2 income unless we abide by his new passive activity loss rules, which I'll explain them to you here in a second. But just for simple terms, if I make that same $1 million W-2 income and I have that same $1 million in real estate losses, I'm now going to have what's called a rental loss carry forward. So I won't be able to use it. It's just going to carry forward to offset new passive income. So I will have $1 million still of taxable W-2 income. I have not saved any money in taxes by owning real estate on my W-2 side. This right here makes real estate unsexy to me. If I can't use real estate investing to offset my working income, it's not as sexy as it was to me anymore. Wouldn't you agree? Now it's just I'm earning passive income and I'm not going to pay any taxes just on the rental income, but maybe you're only earning $200-300 a month off of your investment property. It's not really as beneficial to you anymore. You're like, Carlton, I'm paying freaking $50, $60, $100,000 in taxes over here on the W-2 and 1099 side. That's the real cash flow, Carlton, that I want. Do you see me now? Okay. So let's get around the passive activity loss rules that Ronald Reagan implemented. These are the passive activity loss rules if you want to screenshot this or write this down. There's only 3 ways to avoid the passive activity loss rules. 1, you can either sell your property, which means you're disposing of your property. 2, if you earn less than $150,000 adjusted gross income and you actively participate and you own 10% of the activity that you qualify for. And then number 3 is you qualify as a real estate professional. So a lot of taxpayers don't really fit into buckets number 1 and 2 that I work with, typically because they're making more income. If you're making less than $150,000 adjusted gross income, you can take up to $25,000 in real estate losses. But most of my clients need more than $25,000 in losses. Put more in the chat box if you need more than $25,000 in real estate losses. Most of my clients aren't trying to sell their real estate. They're long-term real estate investors. They're not trying to dispose of their property. So number 1 wouldn't work. And then we got number 3, qualifying as a real estate professional. And you've probably been hearing this one go around on the internet quite a lot lately. A real estate professional is someone who spends 750 hours managing their own property, and they're spending more time in real estate than any other thing, which means you're spending more time in real estate than your W-2 job or your 1099 job. And let's be honest, unless you have a spouse that's not working, it is very hard to try to qualify as a real estate professional. As a matter of fact, I typically only qualify real estate professionals who are already in the real estate field, my real estate agents, brokers, leasers, flippers, wholesalers, or a wife or a husband who's literally has not returned back to work. Like one person's making the money, the other person's taking care of the kids, whatever the situation may be. I'm qualifying that person that doesn't have earned income on the tax return as the real estate professional. That is the easiest way to qualify. That being said, I was a fanatic about studying real estate strategies, so much to the point that I completely read the code section 469 at least 11 or 12 times. It's 179 pages in case anyone wants to know. I wanted to know, how do short terms work? Because Ronald Reagan was in office in 1987. Airbnb and VRBO weren't launched until 2014. So how does Ronald Reagan treat short-term rentals when Ronald Reagan didn't know about short-term rentals at the time? Or did he? Or did he? Short-term rentals. This is in IRC 469, guys. The tax code is so cool. I promise you, this stuff is cool. Short-term rentals fall out of the definition for tax purposes as rental real estate activity under code section 469, which is the exact same code section Ronald Reagan implemented. What? So let me get this straight. There was no VRBO, Carlton, back then. Nope, there wasn't. there was no hotels.com or even Airbnb back then. No. But what was there, Carlton, that would even be considered short-term rentals? Hospitality. What is hospitality? Hotels and motels. How long are you staying inside of a hotel or motel on average? 7 days or less. 7 days or less. Okay, sounds about fair. So, what this means for you, because Ronald Reagan did not know about Airbnbs and did not know about VRBO, he only knew about hotels and motels. And because hotels and motels are considered transient businesses, very short period of time that you're staying in these types of places, you can run a short-term rental business and follow different rules to use your real estate losses that don't coexist with the passive activity loss rules. This is absolutely amazing. Let's go over those rules right now. The big rule of short-term rentals is that Ronald Reagan said all you need to do is materially participate to use your short-term rentals, and you need to make sure your customers are staying in the property for a certain amount of time. So we're going to go over the rules real quick. Material participation in the same tax code that Ronald Reagan released is 7 different tests. In that same tax code that Ronald Reagan released, he said that you only have to qualify for one material participation. I even put the tax code in here, section 469-5T, if you guys are nerds like me, okay? Here are the 3 easiest tests that most taxpayers utilize. I didn't even put all 7 of them up there because the other 4, I know none of you guys would do them, okay? So here are the 3. Test number 1 is your participation constitutes substantially all of the participation. In layman's terms, you do everything for that investment property. You have no helpers, which means even if you wanted to hire a cleaning lady or a handyman to help you out, you couldn't. So test number 1, it could work, but for some of my clients, they would rather automate the short-term rental business and get a handyman and a cleaning lady. So number 1 doesn't work. So then we drop down to number 3. I'm skipping over number 2 for a reason. Your participation in the activity is more than 500 hours during the year. 500 hours is cool. It's a lot less than 750, but dang, that's still 500 hours. That's quite a commitment. So we jump to test number 2. Your participation is more than 100 hours during the year, and no other individual, including non-owners, participates more hours than Carlton does, than you do. I like this one. You mean to tell me that I can close on this property, go through the entire escrow process, which, gosh, the escrow process takes anywhere between 5 to 10 hours, then go through inspections, set up my LLC, get the property furnished, list it on Airbnb, get a photographer to take the photos so I can list it on Airbnb. Man, I'm 20, 25 hours in. I don't even have a customer yet. Do you see how much easier short-term rentals are? This right here opened up a world full of opportunities for many of my clients, especially many of my high net worth taxpayers that did not have time to run real estate operations when their main income driver is their W-2 job or their 1099 job. Your best use of your time is to be in your profession making more money. That being said, we need an asset that we can utilize on the tax returns that offsets your highest income earning stream. That is the short-term rental strategy. Make sure you guys understand this. That being said, I'm going to teach you how to qualify for this without a CPA on the call. You could do this a lot easier than you think. I got all the information you're looking for. Are you guys ready for this? Let me know in the chat. All right. Seems like you guys are ready. Let's do this. Let's jump into this. Step number 1. First off, has this been helpful? Are you guys enjoying this? Is this training helpful for you guys? Let me know in the chat box. Okay, cool. Just want to get some feedback. All right. Step number 1. You must own an investment property. Carlton, my mother has a property. We're thinking about utilizing it. Are you on title? It's in her name. Are you on title? No, I'm not on title, Carlton. Then we can't use it. Carlton, my brother and I are thinking about going into real estate together. We're going to set up a joint LLC. Okay. That is an investment property. You're going to be on title, even if it is a joint LLC. Carlton, I have this secondary home that's a vacation home. It's in Big Bear. We go to it to the lake, but we don't really use it. Can we use that as a short-term rental? Oh, yes, we can. We can. You're on title. Carlton, I have this back house. We live in the front house. No one really occupies the back house. Could we use that as a short-term rental? Absolutely, you can. Carlton, I inherited a property from my parents. Could I turn that long-term rental into a short-term rental and then use that property? Absolutely, you can. Step number one, guys, is you just simply need to have a property that you own. Hopefully, I'm making that as clear as possible. If you're on title, we are in play. That's step number one. Step number two, and this is a rule, you have to rent out the property for a minimum of 15 days in the year. Okay? How many days? Put it in the chat box. I promise I'm not going to allow you guys to mess this up. How many days? Thank you. 15 days before the end of the year. Okay? Not 12 days, not 7 days, 15 days. Carlton, why do you have to rent out the property for 15 days between now and the end of the year? Because there's a rule called the, I don't know, Augusta rule that says if you rent out your property for 14 days or less, you don't have to claim the rental income. How many of you guys have heard of the Augusta rule? How many of you guys have heard of the Augusta rule? Okay, just wanted to make sure that you guys have covered the Augusta rule in this training.
I'm doing my job, brother. I'm doing my job.
I was just making sure, bro. I would have been very, very, thank you. You guys know what the Augusta rule is. Your first 14 days of rental income with the Augusta rule, you're not paying taxes on that. I need you to report income to the IRS in order for us to get the tax deduction. That's why we're going to go 15 days. Please let me know if that makes sense, guys. Beautiful. Okay, awesome. So we're going to rent out the property for a minimum of 15 days. Now, the third step, and this is probably the most important step because getting the 100 hours is not hard. The hard part is remembering this part. Your customers cannot stay longer than 7 days on average between all of your customers in the year. I know you're going to be excited to get your bookings and to have your property all booked out, but you're going to screw up the strategy that you're playing into if you do not create the correct limits on the Airbnb app. 7 days, get out. Bashir said, get out of my house. I love that. You must rent the property on average 7 days or less per customer. You can have one customer in for 12 days, the next customer in for 2 days, the next customer in for 4 days, the next customer in for 5 days. It better be on average 7 days or less in the entire year. Let me know if that makes sense, guys. Put a yes in the chat box if that makes sense. Put a no in the chat box if you're lost and we got to go find you. It's okay. We'll come get you. All right. Why do we need to know the rules? Guys, why am I going over all this stuff? Why am I spending so much time harping on the rules, the law, the rules, the history? Don't you care about being in control of your finances? I mean, as investors, that's why we invest our money, right? We seek control. I would say at the root of why we would even focus on tax strategies to gain control of our financial outcome. So knowing how specific tax laws work can help you improve your ability to receive more cash flow on a month in and month out basis. And let's be honest, most tax accountants and CPAs, they're not like Carter. They're not, guys. So you can't count on other CPAs to recommend tax strategies to you if you've only been hiring your CPA to file tax returns. Tax preparation is a cost. Tax strategy is an investment. You got to learn that first. So this is when tax planning ahead of time becomes very useful. There's typically two types of taxpayers that I run into. I get this ultra aggressive taxpayer that comes in that just wants to write off everything. Carlton, I want to write off the kitchen sink. I want to write off my dog, counter tables, everything. I want my entire life to be a write-off. And then I get ultra conservative taxpayers. Carlton, you know, the IRS, man, they don't play around. I just want to give the IRS my fair share. I know I've been working from home for the last 181 days, but do you think we should take the home office deduction? I'm like trying to convince people to take the home office deduction. Their entire business is working from home. Like, I get the ultra conservative taxpayers that are like so afraid and living in so much fear. So which type of taxpayer should you be? What do you guys think? Which type of, Karen said, be aggressive. Which type of taxpayer should be conservative, aggressive, somewhere in the middle? What are you guys' thoughts? In the middle? Bashira said, my whole life is a tax write-off. I love the energy. Aggressive, risk takers. Middle. I love that. I believe that you should become, and this happens over time, that you should become a taxpayer that is ultra informed. Because if you're ultra informed, you can leverage the tax code to the fullest extent. Agreed? And you can do it legally. So what we're going to do is we're going to all get ultra informed, right? And there are 4 steps on how we're going to leverage that tax code to the fullest extent. Let me explain those to you. Step number 1, you need to have a business. Many of you guys that are sitting on here right now that are out there, in order for you to have an impact on your taxes this year, you're going to need to have a business on the tax returns, whether that's a short-term rental business or something else. I would encourage you to start coming up with your tax play. In tandem with having a business, you should make sure that the government knows that you're doing this for real, which means spend some time in your business. I don't know, maybe 100 hours, and make sure your tenants are staying in the property 7 days or less. Have a mentor or coach like Carter and set up a business plan and strategy like the one I just gave you today. This is the first step to leveraging the tax code. The tax code exists for business owners and real estate investors, and Robert Kiyosaki gave you a tool to learn that. The second step is you have to make sure you can link your business expenses to the pursuit of income. Your business expenses must have a business purpose underneath Code Section 162A. If it's ordinary, necessary, reasonable in nature to you, the business owner, it is a tax deduction. Some of you guys have heard the story of my mother and I, and it was early on in my career, sitting down in the office, and this woman came in, and I could tell that she was, somebody that was making a lot of money, but she was pissed off. We sat in the conference room. She sat across from us, and she slid her tax returns over. And my mother opened her copy of the returns. I had my copy of the returns. My mother asked this woman, why did you come into the office today? She said, I had already met with 13 other CPAs. I want to see what you guys are capable of doing. My CPAs say I can't deduct my vehicle. We open up the return. Sure enough, a notice falls out that says she owes a judgment of $1,004,000 to the IRS. Underneath that, it says they're disallowing a vehicle. The vehicle that they're disallowing is a 2007 yacht that she purchased. A yacht, YATCH, for $1 million. That being said, we asked her a question. Why did you buy the yacht? She said she bought the yacht to show her clients the views of buying real estate from the ocean because she's a real estate agent and she's on the TV show $1 Million Listings. Did I know what $1 Million Listings was at the time? Absolutely not. But what we did was we used Code Section 162A. We asked her, can you give us the log booklet that your captain has where he logs all of your clients that come on and off your boat? It is a law to log that when you have a yacht. And we went into the audit. You want to know how long the audit lasts? We sat down. The auditor had the same documents we had. We went over the case number, taxpayer is taking claim as, We said under Code Section 162A, the yacht is ordinary, necessary, or reasonable in the pursuit of income. Here's the log booklet. Here are the photos of her clients, and here's the income she's made this year. That was it. The auditor was like, okay, next. We literally went on to the next thing like that. Ever since then, I've never feared the IRS again. I instantly knew that the IRS are like dentists. They're just there to point out cavities, bro. They're literally there to point out cavities. You already know you have a cavity before you go into the dentist's office, and you already know whether or not you've been flossing your teeth before you get under. They're going to tell you, hey, Mr. Dennis, looks like you didn't floss. You knew that they were going to say that because you didn't document your expenses. You weren't logging your expenses. You're being lazy. In order to play this game of wealth building, you can't get lazy in this game. You have to know the rules to play this game. And guess what? She was playing the rules, guys. She was playing the rules. She just needed to find the right tax professionals that understood the law. Do you understand now? Everything that Carter and I talk about on here is not because, it sounds good coming out of our voice, just being able to share this information. It's because you get one life. And the decisions that you make sometimes are coupled with who you're getting your information from. So I encourage you to constantly audit yourself, audit your advisors, audit your professionals that you have around you, just like that woman did. She went to 13 other CPAs that said, no, you shouldn't have this yacht on your tax returns. The IRS is right. She came to my mother's firm. My mom's like, okay, cool. You bought a yacht. Why did we buy it? There's a difference, right? Link your business expenses to the pursuit of income. Code section 162A is how you do so. Step number 3, keep proof of your payments. We would not have been able to win that audit, I promise you, if we did not have that log booklet. I promise you guys, that was the one thing the auditor cared about. He was like, oh, it's in chronological order. It literally says the date, the time, the activity, and the people that were on the boat. Guys, we couldn't fake this. I mean, she really ran broker previews on her yacht, right? She kept the receipts. She bought champagne, Veuve Clicquot, you name it. It was a tax deduction for her. I don't care how much she spent on the alcohol. She kept the receipts. It was ordinary for her business, necessary for her business, in the pursuit of income for her business. She is the one real estate agent that sold Kobe his house in Crystal Cove here in Orange County. Pretty cool stuff. I know I kept those receipts, right? All right, last but not least is we need to report your expenses properly. How many of you guys on here, oh my God, I hope you don't. How many of you guys on here file your own tax return, or you're comfortable admitting you filed your own tax return in the past? Carlton, I'm probably not going to do it again, but I've tried it. You want to get honest with me right now? I'm only here for a few more minutes. Do you want to get honest with me, Carter? Carter, look away. Did you file your own tax returns? Be honest with me, guys. Just be honest with me. You've done it. Trying to save a buck here and two. You know what happens when you file your own tax returns? Not only do people like me and Carter laugh, but what happens when you file your own tax returns is you guys use all these random weird categories that the IRS set up as fail traps for you. Carlton, I didn't know where to put it, so I put it in other expenses. Question, what are other expenses? I don't know. Carlton, I didn't know what that expense was. It didn't fit into tools. It didn't fit into education expenses, so we just put it in miscellaneous category. What is miscellaneous? I don't know. But y'all using these categories on your tax returns, sticking out like sore thumbs to the IRS, wondering why. Why am I getting audited? You know, they talk about all the time they want to audit these billionaires, but I'm the one receiving the audit. How is it me? When are they going to come after them? Them know different things, and them would never file their own tax return. Do you understand? Become like them. Don't file your own tax returns. Let's all get smart. And guys, sorry if I'm coming off a little aggressive right now. I'm just so passionate about taxes. I'm passionate about what I teach on. This is my profession now. I don't have football anymore. I didn't go to the NFL, okay? So this is my NFL right now, okay? That being said, here are the most common tax nuances I see. I see people not keeping proper receipts. We live in 2024 and you have an iPhone. There should be no reason why your bookkeeper and you do not share a catalog on your phone in your photos. You could literally have a shared album with your bookkeeper. And every time you take a photo of your receipt, your bookkeeper gets the photo of the receipt in your shared album on your iPhone. Let's wake up and start utilizing that. No accounting software. Man, we're trying to build the house. We have no hammer. Pretty hard to do that, huh? Disorganized records. When you have not done your bookkeeping and accounting, and then you contact a tax strategist like me or Carter to try to help you to figure out how to reduce your tax bill, and you're all the way back in the month of January with your bookkeeping, and we're over here in the month of June, it's very weird and awkward conversation when we're trying to project out how much we can save you because you're 5.5 months behind. Make sense? How about commingling expenses? Again, this is being lazy. Everybody knows that when you start a business, things that go in the business are meant for business, but you choose to commingle expenses because you get lazy and you just want to take the easy route. Easy burns you in the long run. Always choose the harder thing. These are the most common tax nuances I see. Now, I'm about to jump off here, but before I do, I got a couple questions I want to ask. Why do the wealthy stay wealthy, guys? Why do Why does Uber, ESPN, Apple, and McDonald's pay 0% in income taxes? By the way, I don't know if you knew this. ESPN, Nike, Bank of America, McDonald's, and Apple paid 0% in income taxes on their 2022 returns. How are billion-dollar corporations paying less taxes than you? What are they doing? They're doing tax planning, guys. If you're planning to pay 0% every single year, you're probably going to get really good at it if you're planning to do it every single year. So let's go over how we can do strategic tax planning as well. There's 6 ways or 6 steps to doing strategic tax planning. I'll explain those to you guys. Step number 1 is you have to get organized. A tax strategist like myself cannot do anything for you if we're not in real time. Today is June 11th. I should be able to have your income from January up until June 1st. Why? Because I have 6 months left in the year to forecast out the remaining money that you're going to make potentially and let you know what you're going to owe today. Now, you guys are all smart. If I told you what you were going to owe right now, you already knew what the number was. Are you going to want to change it, or are you just going to let it stay there? Put change in the chat box if you're going to change it, but stay if you're just going to stay there. Are you going to try to change what you owe? You're going to stay there. Okay. That right there is control. Carlton told me how much I'm going to owe for the 2024 year, even though the year's not over yet. And now I already know this number. So I have control now to decide how to change that number. Now we're incorporating some wealth building tools here. That being said, step number 2 is before we start changing everything, someone needs to look under the hood. It would be really weird if you walked into a doctor's office and it's your first time walking in the doctor's office and you sit down and they put their hand on your head and they're like, yeah, she needs ibuprofen and morphine. And you're like, hold on a second. No one took my height, my weight, my blood pressure. No one ran a blood test on me, looked at my family history of heart disease. How do I know they're prescribing something I'm not allergic to? Your CPA or tax strategist should be spending time reviewing your prior 3 years tax returns. Why? Not because we want there to be an audit that we all of a sudden find on those previous returns, an audit risk. We want to go back and see if there's missed opportunity on those returns because the IRS gives you 3 years to go backwards. You have 3 years to go backwards on those returns and to include strategies into previously filed returns. I would love to get a federal tax refund coming back to me before I start planning on my 2024 strategies. It changes the game a bit. So this is actually where we start. We start off by reviewing your past. Now, once we get past reviewing your prior returns, now we can jump into your current situation. Now we can jump into June. It's June 11th today, or June 11th. Where are you at currently today, Mr. Johnson? Are you planning on moving from one state to another state because you're trying to escape high state taxes? Maybe you're getting ready to start your first Airbnb business. Maybe you're saving up for college for your children. Maybe you want to take out a HELOC, a home equity line of credit from your house, so you can start doing some more additional investing. Maybe your parents are getting older and you're worried about some of their assets that you're going to inherit. Your tax strategist should know this information ahead of time, like way ahead of time before tax season. So they can help you plan strategies around your personal goals. Then we go into the business stuff. Are you self-employed? Do you have a business? Is it an LLC? Is it an S Corp? Do you need a management company? Should we place your children on payroll? Are you doing the Augusta rule? Should we add your wife to salary? Should we not add your wife to salary? Then we go into the business goals, which bleeds over into real estate. Are you going to qualify as a real estate professional? Are you going to utilize the short-term rental rule? Are we just going to invest in real estate passively until you do qualify as a real estate professional or can utilize the short-term rental rule? How much depreciation do you need on your tax returns to wipe out all of your W-2 and your 1099 income? And last but not least is your retirement goals. Many of you guys maybe do or do not believe in retirement accounts. I have clients that are like, dude, I love 401ks. I have clients that are like, dude, I wouldn't touch a 401k. So your tax strategist should probably know your retirement situation as well. This is the phases of doing tax planning. Now we're at a point where your tax professional understands your vision. They understand what's going on in the current year. They understand what's going on in your personal life, with your business, with your real estate investments, with your retirement. And they even took the opportunity to ask, what's happening in the future? What's happening next year? Do we want to sell this company? Do we want to be a real estate investor long-term? Your tax professional has to ask the right questions, because once they do, then we get to the point where you have the right plays. This is what I remember right here when I was in football, getting a playbook. I love getting a playbook because if I got really good at memorizing the playbook, I can go out there, execute on the play, and win the starting job. And then once you win the starting job, you make the plays in the football game. When you make the plays in the football game, you're the winner, you're the star. That's what I want for everybody on this call today. I want you to get to a point where you have that tax professional, that coach that is helping you implement the right strategies. And I believe that a lot of you guys have found that being in this tax-free living environment. Guys, this is tax planning broken down to you. And once it's broken down to you, you don't give up on implementing strategies. It is like being on a treadmill. You never get off. You keep going, which is continuing the conversation with your tax advisors. If you guys are interested in learning more about the short-term rental rule, place the QR code here on the screen. Feel free to grab our ebook, $7. Feel free to lock in on that ebook because it will give you information on how to qualify for the strategy. It'll go more in depth around the tax law and the tax code around short-term rentals. I put in there about 4 or 5 case studies of my W-2 clients and 1099 clients that have gone through purchasing their very first short-term rentals. I go over how much their down payment was, their debt to income ratio, what other debt they had to pay off in order to be able to do this strategy, so you guys can really understand how possible this is. So if you're interested in grabbing that ebook, it's right there for you. That's the end of my presentation. Any questions that I can answer? And again, just want to thank Carter for allowing me to come on and rap with you guys for about an hour. Man, I'm over my time, an hour and 15. I apologize.
It's all good, brother. It is all good. First of all, can we give Carlton a round of applause, some fire emojis in the chat? Like, my brother went crazy, man. Like, that's my second time watching you do that presentation, and it gets better every time. I see you've been putting in the reps, brother. You've been putting in the reps. So thank you, bro. So I'll do Q&A. You don't have to worry about that. Like, just in case y'all didn't know, Carlton is about to have a newborn daughter any moment now. Like, could be hours, could be days. So, bro, go handle your family. I'll stick in here for Q&A. But thank you so much, brother. I'll call you when things get settled. We'll catch up. But thank you so much for blessing my people, and I look forward to talking to you soon, my guy.
Bye, guys. Thank you so much for having me on, Carter. And good luck out there, guys. I look forward to hearing about all of your guys' investments over time. Take care.
Okay, y'all. Was that good, or like, somebody let me know? Somebody let me know. Was that some of y'all? Some of y'all literally speechless. Like, some of y'all are literally speechless. But again, so I knew a lot about tax strategies for business owners, right? And what Carlton helped me start to learn and realize is the tax game for real estate investors, right? His team, his clients are mainly real estate focused, and he helped open my eyes, right, on the different strategies that real estate could bring to us. So last year, I actually bought my second property. It's a $1.2 million property in Texas, and I ran the cost seg study. And this property, matter of fact, hold on, this property helped me save about, let me see if I can find it. I think it's like maybe $286,000 in taxes. So like, he opened my eyes and gave me the courage and the strategies to run the play that I knew I needed to run. And let me just show you how this, again, we like receipts over here. So I bought a property last year. I did my cost seg study. And as you all can see, this property is going to save me about That was the old estimate. I think it's about 228,000, my bad. $228,000 in year one. In year one when I bought the property. So that's literally wiping out $250,000 in taxes by leveraging one strategy. So I know y'all got questions. So I'm gonna let y'all raise your hand and I'm gonna go ahead and start calling on y'all. Anybody that has questions in regards to anything that we went over today. So I'm gonna go gallery mode. Mika, you up first.
Hey dear, thank you so much. That was wonderful. I'm just, my head is exploding. I mean, it's exploding so much. I got a crick in my neck. It just look, I'm just like, wow.
Yeah,
So
you thought we was gonna stop in the challenge? No.
oh my God. Oh my God. Oh my God. So look, check this out. How do we get started in purchasing properties? You like, I don't know if you remember me saying this, I live in Los Angeles. So is it like, do I look around in other states? You know what I mean?
So Carlton doesn't own a property in LA, and he's been living in LA his whole life. I don't own I was living in LA for 2 years. I would never buy a property in LA.
Yes, that's crazy.
So you can buy properties in different states, right? So my properties are in Chicago and Dallas. So I recommend you buy a property where you have somebody that knows the area, and we actually have a partner that will. If you want to buy in Florida, we have a partner who will help you find the property, furnish it for you, and list it on Airbnb and manage it. I mean, now you do have to, he does have his own consultation fee for doing all that, but that's, yeah, Peter. So he spoke at our last mastermind. Carlton got, worked with Peter. He paid his consultation fee. Peter found the house, helped them close on the house, furnished the house, and operated the house for them. It started in November and they got their hours before the end of the year and was able to write it off. So I will put Peter's information in the chat for anybody who's looking to buy in Florida. Now, if you don't want to buy in Florida, he can still help source you to the people. So I went through Peter to find my person in Dallas and help me close on a property. So I will give you all Peter's. I'm gonna text Peter right now. I don't want to give out his phone number, but I will give out his what's up, bro? Can you send me your consultation link? Is that your only question?
The other question is the tax part, which is very important. It seems like that's the foundation for all of our success. We got to get our well, some of you may already have your things in order, but for us that need to get our house in order, what is step one for us? Like how do we, because he said we probably need to go back 3 years. We need to find our person, you know?
I got you. So our firm does a tax review for you all that comes with the program. Okay. So once you have your goal setting call with our financial advising team, they will look at whatever your goals are. You say, I need to fix these taxes. Then the first place they will push you over to is our tax team, and they will review your prior year taxes. That's why we include the prior year tax review, because like I mentioned at the beginning of the call, so many of our clients make their money back from the program just off the prior year review because we're able to like find the money that you missed out on.
Okay, that's it. Thank you, dear. Keep it coming. Keep it coming.
We just get started. Yeah, just getting started. Okay, cool. Peter just sent me his booking link. See, that's why you gotta have friends that stay ready. He taking 30 seconds. Stay ready. You don't have to get ready. So I'm dropping Peter's link in the chat for anybody who wants to reach out to. We even got a special customized link. Look at Peter. Love my guy. Okay, cool. Do you want me to change? I don't know. Okay, cool. Crystal, what's popping?
All right. So how do you find the right person who does cost segregation studies?
We have a partner. You all, same partner that we use at ICS Solutions. They give all of our clients discounts on cost seg. The reason we can't include the cost seg, because different prices for cost seg. The bigger the property is, the more expensive the cost seg is going to be, and the smaller the property is, the cheaper the cost seg study is going to be. So if you reach out to Leilani or Tamika, they will be able to get you over the link for our partners for the cost seg study.
Okay.
Cool. We got y'all. Okay. Y'all don't have to go out and we figure, okay, y'all gonna need this, we need to find somebody for this, y'all need that, okay, we have to find somebody for that. Y'all covered on all ends. Cool. All right, Crystal, appreciate you. Colette, how you doing?
Hey, Carter, you know what? I actually just didn't lower my hand because Mika asked my question about whether or not it had to be in state, because I'm in Cali too, and you know, property out here, so.
Ain't doing that. We ain't doing
Yeah,
that.
exactly. So I'm actually really good. Thank you so much.
No, thank you for being here. Cool. V Knight.
Mute. Hey, I need to remember to put my name on here. It's Vanessa. I'll start putting
I'm about to
my
say,
name on here.
yeah,
Sorry.
yeah, the
But
camera couldn't even see it was you. Okay, hey, what's up?
another screen, yeah. So I have a question about maybe the ordinary expenses piece of it. So if we're paying to furnish a property that we are planning to rent, but we either haven't yet or there's been like a pause. So I house hack. And so some of the money that I spent in the past has been like, well, I'm going to upgrade my house because if it was just me, maybe I don't have the budget for it. But since I've got renters or I'm planning to have renters, right, I would do stuff. But so I'm not consistently renting. I'd have to try the short term rental part. I was doing like medium to long term. So I just want to double check whether that tends to be easy to justify for ordinary and regular for like art, like repairs to the house, yada yada, services. So
Yeah,
apart from the cost ag.
absolutely. So when the IRS gives us the ordinary and necessary clause in Code Section 162A, the benefit of that statement is that we essentially get to decide whether something is ordinary and necessary based off the use of that item. So
Mhm.
if you're house hacking and you're furnishing the room that you're renting out, all of that is 100% tax deductible. But if you're furnishing your room, then none of it is tax
Right.
deductible. That's the personal piece.
And
So
if it's the common area, like I know that percentage kind of changes depending on the whole percentage of the home being rented out, but like that's the thing that throws me is if I'm not actively renting it, but overall by the end of the year, I'm going to have used a certain percentage of the home for business use, right? Is that kind of, can you retroactively just apply that percentage?
So so if you were to furnish and if you're furnishing an Airbnb, all of the furnishing is tax deductible, right? But it's
Okay.
because you're living in it, if your house,
Right.
the common areas don't count because IRS is gonna say like, yo, that's you use that common area too. Like, so
Mm,
you're splitting the home, they're saying, well, the only area in this home that you're gonna be able to deduct is the area that the person is living in.
got
Anything else
it.
pin towards you to say like this is your
Mhm.
you use the kitchen counter, you use the living room, you use the TV in the living room. So you're not
Mhm.
gonna get away with writing off other furnishings unless you just rent out the entire unit.
Okay. And then one last quick clarification. So if I move out, because I was planning to try and do that this year, I just was recovering from like a surgery. Am I able to still kind of course correct and still be able to write some of that stuff off? Like if it was expended in that year to basically upgrade the place for the eventual renting the whole place out, and then I'm out of it like half the year, would I be able to kind
So
of
like
do like percentages of those expenses?
if you're saying if you rented out the whole house fully for part of the year and then you lived in it for the other part of the year.
As in, sorry. So thus far, I've been in the house this
Yeah.
year, but I'm saying if I were to move out, because basically I will plan to do that lickety split. Like if it's going to help me be able to write off the stuff that I was technically in my mind upgrading because a renter would want it to look a certain way.
Yeah, so let's say you spent $50,000. I'm just throwing a number out there for easy math for me. Let's say you spent $50,000 renovating a place, but 6 months you lived in that place. I,
Mm-hmm.
I would tell you to only write off 50% of it because half
Right,
the year
right.
it was you and half the year that wasn't you, right?
Mm-hmm.
So I would want you to base it off the time you spent in the property.
Okay, I'm good. All right, thank you for your time.
Great questions. Trevor Smith was popping, my brother.
Hey, how's it going? Excellent call. I have a question. So we have a rental property that we have, and it's an affordable housing at the moment, like it has a tenant in it. And so the strategy that was just offered to us was like for Airbnbs. So would we recommend selling this property and then trying to get Airbnbs? Or do we keep it because we have a sustainable income? Like it's the affordable housing, like it's paid every month. Like it's just, we are getting that. And so it's like, that's been great for us. So I want to know what's the best advantage that we should be taking advantage, or what's the best strategy that we should be using to take advantage of this?
Yeah, so Trevor, your question is, you all have a property that's cash flowing, and from my understanding, it's affordable housing, so the government's cutting the checks.
Yes.
Should you sell it so that you can purchase a short-term rental so you can save more on taxes?
Yes. Yeah.
Personally, I'm not selling a property that's cash flowing from the government. I'm not selling the property. Now, what you can do is get creative, and I don't know how much equity you have in the house, but I would recommend you like pull some equity out of that home and use the equity out of that home as a down payment for your short-term rental this year.
Yeah, we don't have, so we have some equity, but we've looked into it and the banks won't give we looked into multiple, like even just trying to get a HELOC on it. And there's not enough right now in order for that to happen. So we just, that's where I've looked in some of those, and the banks just haven't been able to do that as of yet.
Yeah, because if you sell the property, you're creating a taxable event just to buy.
Yes, but only if we get pay capital gains. So we'd have to get a property that's larger, right? Square footage wise, so we don't pay capital gains.
Yeah, so if you so you can sell the property if you want. Again, I'm not, because like unless you want to, right? Because I think that a property that cash flows, especially from a government standpoint, that's a good investment, right? Now, but it all depends on how much it's cash flowing. But if you sell that property, you can't do a 1031 like kind exchange. You have to identify a new property within 90 days and close on it within 180 days, and then you could use that new property as a short-term rental and be able to run the cost segregation study as well. But again, I just don't want you, like, I don't want you creating a taxable event to try to solve a tax problem when when you could potentially just get another property, or like find a way to make enough money to get another property, find a way to make enough money for the down payment on a new property.
Okay, I hear that. I also was also thinking in my mind is that we live in Massachusetts, where like our property values have very similar to like California. So like there is some, so my play was like thinking like what you guys said is like get a property in a different state that we could leverage for. So, but if you're saying keep it, we'll just keep it.
I'm just saying, this is a financial advisor. Like this is a then we're not talking about the tax piece of this question.
Right. Okay.
We're talking about the financial advising piece for this question, which I would want somebody to look at your property to give their best assessment. Is it overvalued? And like, is it like, do you want to get out of it? But like from a tax standpoint, unless you're going to 1031 like kind of exchange it, I personally would recommend you probably don't sell it. But then asking a different question.
Yeah, no, we want it for the tax purposes as well. So I guess my question was like, should we keep it for those tax purposes, or should we like? You answered it. Thank you. Don't sell it. Don't sell it to create another tax problem. All right, thanks.
Gotcha. Great question, Lorenz, brother. Hey, look, I love my body as much as you, but if I gotta have a shirt on, you gotta have a shirt on too, my brother.
Oh,
What's going on, man? I was messing with you.
Oh man, what's the word, man? I wasn't prepared for that one. But quick question. So as far as the business goes, like when you start up the business, to acquire your first year in losses, like say for example, with all your expenses, it could be, a phone bill, it could be 80% of the car note, whatever is, ordinary and necessary for the business. When you write that off for the first year, how much money needs to be generated in your business to be able to write off the losses for the first year?
Just income, right? Like we need to have proof that our business has income. There's no cap on it, right? There's no like you have to make $100 or you have to make $500, you have to make $1,000. There's no limit. The IRS just says you have to make money and be able to prove that this business is in the pursuit of income, right?
Okay.
So that's a long way of saying like the business just has to earn some money for you to be able to unlock your deductions. Because again, the point of business, y'all, is to make money. And the second point of business is to save on taxes. Don't forget the.
Okay, got you. And then my other question was, as far as I know, you guys refer to QuickBooks often, as far as just keeping receipts on everything that you pay for within the business and things like that. So, within my business, would it be wise to just use QuickBooks for the installments of the payments that we pay for this course? So that way that could be, used within the loss. Is that something that should be done as far as QuickBooks go?
Yeah, I mean, you want to set up your bookkeeping the right way, regardless, right? From your business from the get-go. And I personally, I've tried a lot of different platforms, and QuickBooks is this most seamless, best operational efficiency, and the best priced. And once you set up QuickBooks, you simply link all your cards to QuickBooks, and they automatically categorize or pre-categorize your transactions for you. So if you set up QuickBooks, have your credit card, and you swipe it at the store for a new computer, as soon as you swipe it, it's already in QuickBooks saying it's equipment, right? So,
Okay.
so the short answer is yes, and I love QuickBooks the most out of all the softwares. So,
Okay, bet. Appreciate you, man.
no problem, brother.
All right.
Yes, sir. Janine, where your head at? How you feeling?
I'm good. I'm good. I'm a little overwhelmed too.
That's why I asked you where your head at.
I know you can tell, right? Couple of quick things. One, regarding QuickBooks, you use the online version?
I like QuickBooks Online. Yeah.
Okay. We we have a 27-year-old catering company. My husband's our executive chef. I'm our business manager. We've been doing really well. We're in the Durham area. So we have an established business. I just launched something new. But regarding the real estate thing, and I'll get into some of those other particulars like in with my one-on-one, but regarding the real estate thing, I've been thinking about real estate for a while, but quite frankly, I'm really scared to death. And I just put in the chat about the situation that just popped up here in the Raleigh-Durham area. This lady had a long-term Airbnb. Now the people don't want to leave. She's having to evict them. And so my thought was, don't do long-term Airbnbs. But my question is, like, other than the house I live in that I'm sitting in, I've not owned real estate. So I really don't know. Should I be looking at a Section 8 property? Should I be looking at maybe a 2-unit duplex, a rental like that? And then where am I going to get the money for the down payment? I work at Duke full time, and then I have my businesses, but I have a 401(b). And you talked the other night about I think it was called an individual 401(k). So yeah, so and maybe this isn't the time to do. I just want to put this out there, and then maybe you can revisit it with me later or somebody on your team. But do I move some of my 401(b) money into this individual 401(k) and then leverage? You know what I'm saying? I'm not real liquid with, I have some money, but I have a daughter who's about to move to Virginia. So my liquid money is going to my 28-year-old. But so I need to generate down payment money to buy a piece of property so that I can run this play. And I'm not sure what's the best way to do that.
Yeah, so great question. Great question. So I would say, one, definitely bring this up in your one-on-one, because once they see all of your once they see all your finances, they can come with a better answer of what they think that you should do based on your situation. So I'm answering this off of just a high level knowledge or understanding. And real estate is important, right? Real estate is a great way to invest and save on taxes, right? It's very few investment vehicles that will let you appreciate with your investment while saving on taxes at the same time. What I will say is that as a person who's experienced real estate, I personally would wait until I'm liquid. I would wait until I'm liquid to buy a property, because once you buy the property, guess what, Queen? The expenses don't stop.
Right, right.
If you don't get somebody in it the first month, guess who gotta pay that mortgage? You.
Right. So maybe I should be looking at like Vanguard or SB, like other investments and hold off on the, okay.
And here, me and Carlton preach. This real estate cost seg study is for people who are earning a lot and have the access income to invest in it, right? Like,
yeah, I'm not there yet.
Isn't a beginner. They're easy ways to save on taxes. Okay,
yeah.
They're easy.
Yeah.
This was my last strategy. I'm like, bro, like I did everything. I still got a tax. I have to buy a property. Like it wasn't a if and or but about it.
Yeah.
So that's my answer to your question, if that makes sense.
Okay, yeah, it is. Okay, it is. Thank you so much.
No problem, no problem. So is it Deron or Dayron?
It's the wrong, bro.
Deron, you
Yeah,
can't, you MG, and you was in a tax-free one. I remember I remember you. I was actually rewatching the recording the other day, and I was like, my dog, what's up?
okay,
Good,
how
how
good.
you doing, brother?
I'm good. Yeah, I really enjoyed that. He was. I'll say Carlton is like one of the, outside of you and George, one of the best presenters that I've seen.
I wouldn't have, like, because I could teach the class too, but I was like, I wouldn't have brought somebody who I didn't think could equally hold it down as well.
Yeah. I mean, it was just like polish, and it just like you, it just comes second nature. So it was really, really an excellent presentation. I'm just always wondering about this cost segregation because I purchased a house. I have a rental property up in Maryland. It does well. It's good grief. It's cash flowing about $1,600 a month, which allowed me to buy the house here. And I really wish I would have been able to be a part of this before the end of the year because I would have took this house because I put a ton of money into renovations of this property now. And been able to cost segregation that for the 2023 taxes, that would have probably just been phenomenal. So I'm wondering what, outside of, doing a whole renovation, do you have to wait to write all of that stuff out when you get ready to possibly sell the house, or is it anything that's depreciated now?
Yeah. So your renovations are added to the depreciation schedule every year, right? So your renovations are depreciated over, I think it's 15 years, right? So let's say you spent $100,000 on renovations, you would depreciate that over 15 years. So you take that 100,000 divided by 15, and that will be your depreciation amount every year for the next 15. I believe it's 15 years. I gotta double check.
Okay.
I think it's on a shorter schedule than your home. But you get to start taking those immediately. You just can't take it all in 1 year. Now, what the IRS says is there's a difference between improvements and repairs, right? Anything less than $500, you can deduct this year. They call that de minimis, which is basically saying it's too small, we don't care about it. Anything less than $2,500, you can just expense in the same year. Anything more than that has to be amortized into the future.
Okay. All right. Yeah, it was a bunch of tearing down, rebuilding, structural stuff. So
do you have like a log of all the money that you spent and like?
Oh, absolutely. I got the painful receipts.
Cool. We gonna need that. So
Okay.
I was just making sure that you had that, and that will be used for your depreciation calculation.
Cool. All right. Appreciate it.
Good question.
Oh, wait a minute. One more thing. This is just me. I don't know if you can see partial of my collection over there. What are you doing? Certain custom, or are you going designer for your shoes?
I'm actually I'm not a big shoe buff. I love Jordans, and I just, if I go in the store and see them, I'll buy them. But I never like stood outside or like, hey.
Oh, no. Yeah.
Okay,
I'm
yeah.
a little too old to do it standing outside, but I got an unhealthy problem over here. But
They look good though. They look good.
All right. All right. Appreciate it.
All right, we got two more. So we got Kenyon and Joe. Hey, that wasn't the same name that was in the challenge the other day. Y'all, that was the same? Okay, maybe I'm wrong. Okay.
Yeah.
I was about to say, I thought that, okay, my bad, that's on me. How y'all doing?
Nah, we good. We appreciate y'all, man. Y'all put on tonight, so that's what's up.
I'm glad we was able to continue to learn and keep y'all impressed. Y'all a tough crowd. No, I'm kidding.
Now, all right, so get into it. So we have a similar situation to I think it was Trevor, in terms of we currently have a rental property with tenants in it, but they're there. Do we have what options do we have in terms of do we have to kind of acquire another property before the year is out, or is it an option? They're on basically a 30-day notice. We're already halfway through the year. Is it an option can we apply that that short-term rental to that somehow, if we were to convert that to something else, or do we just have to take equity out? We do have a little equity in the place, so we could possibly purchase another property, but so what's our
Yeah,
best path forward?
that's a great question. And I just want to preface by saying this sucks. There's no way around that. I vetted, I talked to my tax mentors about it. And if you're gonna run the cost seg study, you need to run it in the first year that you acquire the property.
Oh, okay. Okay.
Yeah,
So we
so
got to purchase.
we can't go back. And I talked and tried. Nobody, it's not possible. So, in your case, if you wanted to leverage to take advantage of the strategy before the year out, you would have to find a way to get a new property and get it rented out before the year's end, which again can come from equity, and the property can come from just saving up additional earnings, saving up some year additional earnings for a property. But yeah, you would have to do the cost seg the first year that you acquire the property.
Okay. All right. We already got a appointment scheduled with Pete, so we on it.
Let's go. Let's go. Let's go.
Yeah, yeah, yeah.
Action taker. I love it. I
Yeah.
love it.
right.
Okay. Thank you. Thank y'all. I appreciate it. Ken, what's going on, Queen?
Hey, good evening, everybody. I had a question about the interest payments on the loan, like the home loan. If you're doing a cost segregation study and like the example that Carlton used, say you're getting a $400,000 loan from the bank for the house and you use $100,000 of it for the down payment, are you able to deduct interest payments and that kind of stuff as well, and you do a cost segregation study? I don't know if you can do that or not, but I was just curious.
Yeah, great question. So interest on any property is always deductible, whether it's your home, whether it's a rental property, long-term, or whether it's a short-term. Cost seg, the point of that, we just want to accelerate the depreciation. Like all the other expenses, interest, homeowner's insurance, that's already deductible. We just want that depreciation that's 27.5 years. We want to get that faster.
Okay, so the only stipulation is just it has to be over the 14 days so that you can't kind of double dip with the Augusta rule.
The stipulations for the cost seg study is you need to rent it out at least 15 days. You have to have an average stay of 7 days or less, and you have to work on it 100 hours more than anybody else. Those are the 3 stipulations.
Okay, so the 100 hours is what qualifies you as a real estate professional.
It qualifies you as a short-term real estate professional, yes.
Okay, how many hours do you have to work to qualify as a real estate professional to be able to get the perks of that?
750 hours, and you can't have another job.
Oh, okay. So you can't have another job. Okay, well, thank you. Those are my questions.
And that's the major problem with it. Okay, Lindsay, I was wondering, like, y'all had your hand up and y'all put it down. I was like, okay, I think they got a question he's nervous to ask, but y'all put it back up. So what's up?
So I'm not nervous. I'll ask the question.
Okay.
Okay, so we've had a boat-based manufacturing business for the last couple of years. We did not get a 1099 last year because the amount of money was lowered. It was not an LLC until, what was it, the beginning of the year we made it? December. Like the boat that we bought in 2020 or 2021, would expenses like the payment and the insurance and the gas and stuff like that be deductible because we take it out and we show people we sell on our boat? It's
so okay, so give me some insight on the business. So how does the business make money?
So it's we manufacture boat parts, right? So these parts are installed on the boat, and then it's kind of like show and tell, in elementary school.
You can hop on our boat, we'll show you this
Right.
and that and this and that, and
But then we use the boat for R&D as well, because there's very specific measurements and things like that, sizes, for stuff. So the boat, without the boat, we can't make the product. So we were just curious if there's anything we could do with this liability that we have.
Yeah, so, and you all started the business
We did.
last year?
Officially, yes.
Okay.
We've had it for a couple of years, but
As far as Uncle Sam knows, it was last year.
It doesn't like so. Just the reason I'm asking this, you'll see in a second while I'm asking this with these questions. When did the boat business start to generate income? Is my question.
So significant income, honestly, this year, 2024,
Okay.
after the business was created, because that's
Yeah.
when we really, started hustling with it.
If we're going to try to write off boat expenses, we need to be very easily be able to prove that we earn money in the boat business. So I wouldn't go back and change anything for previous years, because if you didn't really earn money in 2023 on the boat, I wouldn't go trying to write off a boat expense, because the chances of an audit, it's not high, but it's higher than other categories. But if you have a boat business and you have a boat and you're using your boat to help you earn money in your business via like research and development, training, show and tell, or things like that, you will be able to write off a portion of the boat's expenses, which is the notes, the insurance, some of the repairs. But I would just want you to get very like clear on how much you use the boat for personal versus business. Right? If you take the boat out every Saturday for fun, that's fine. But if you use it during the week for work, that's fine too. I would really want you like to have a work log on the boat, just like Carlton mentioned in that last example. I would want you to have a work log every time you take somebody on the boat for the show and tell and things like that. And then I would like you to come up with a good percentage. Like, hey, God, we probably use the boat 40% business and 60% personal, or maybe more than that. I don't know, but that would be the percentage that you would be able to write off the boat.
Okay.
It's related to.
All right. Thank you.
thank
Great
you.
question. Okay, family, that's everybody's questions. Great class tonight. I hope y'all enjoyed it. It was fun for me to watch you all learn a new strategy and really go deep. I know I went over it briefly in the challenge, but I want to hit it more in depth inside of the program so you can understand how to take it, what to do, what not to do, and things like that. So super happy for tonight. And we're back again tomorrow for our business class. Every month I do a tax class, George does an investing class, and me and him together do a business growth class. So that's going to be tomorrow. Again, if y'all need a break, I understand. Like y'all seen this for 5 days. Some of y'all seen this 5 days and came back and see this on Monday and Tuesday. If I need a break, I understand. But if y'all want to come there, we always hit a show out. So other than that, have a great night, and I'll see some of you all tomorrow. Mika said no breaks. Peace
Thank
out.
you. I appreciate it.
Oh, yes, sir.